Hi everyone, this is Nuresh Mirani from nureshtech.co.in. Yesterday we had mentioned about how one should not rush into buying and selling stocks because of the new SEBI circular. And we've got a clarification from SEBI, and it's very interesting that on a Sunday SEBI has been working and clearing the doubts. Now the fact here is most of the people will be looking at how it is the current circular is a step in direction of small caps and how you should buy small caps. Somebody will be on the other side saying you should sell small caps, this regulation, etc. But I would like to focus on something which are, say, very big implications for the industry in terms of the direction of the SEBI. Now, the first part is the multi-cap fund. People may call it mis-selling or whatever be it. The fact which I have a problem is if SEBI had a, say, problem in principle with the way a multi-cap fund should be true to label, the regulation has come very late. Why do I say late? So if you look at the multi-cap fund category today, say on August 31st, the total AUM was around 1.46 lakh crores. The large cap fund AUM is also closer to 1.48 lakh crores. So it's almost become similar size as a large cap fund. So, and also even in terms of number of folios, this is 95 lakhs. The large cap fund is 1.03 crores. So it essentially tells you the multi cap fund, for example, has more schemes than the large cap fund. So, for example, the largest scheme with the largest mutual fund category with almost the largest number of schemes, if you remove the thematic and the ELSS, and one single regulation changes the way it should be run. So that has some very strong implication in the long term, and also the clear circular or say as well as the clarification tells you that this scheme has to be run this way going forward, and eventually this category is almost becoming going to become redundant, and most of the funds will shift towards a large and mid cap fund or another category or find some other creative solution, because an exit is not the way out, because if you give an exit you lose AUM, and nobody likes to lose AUM and fees, especially in the asset management industry. Now the problem is when we talk about, say, the theoretical number was 27,000 crores of new small cap buying. The fact is India is a very say shallow, low depth market and very high concentrated in terms of the shareholding. So the small caps cannot digest a gush of 5,000 to 25,000 crores in the next 6 months also. The fact is, say, in one of the articles by Capital Mind, they've mentioned if Kotak Mutual Fund has to buy 7,000 crores of small caps, it will have to buy 1% of all the 250 companies from 251st to the 500th. And that's going to be very difficult. Why do I say it will be very difficult? Because in India, this is the structure of the market. In large caps, 50% of 45 to 55% of the companies owned by promoters. Another 20% is owned by FIIs and 15% by DIIs. That's roughly been the, say, and another some with say PMSs and HNIs, etc. So the actual float is left to be around 10%. Same thing happens with the small cap. The worst part in the small cap is a lot of small caps have promoters owning closer to 75% stakes, and say generally it is 55 to 75%. So the actual available float is much lesser. So for example, you may look at the free float for a company like even as large as Atul Limited, as in it's not a very small cap, but it's a fantastic company. But even though when the promoter has only 45% of equity, mutual funds and insurance has around 25.31% of the equity, and say 6-7% is with the FIs. So basically, in even a company where a promoter is 45%, I can point out many say decent mid caps and small caps where the actual tradable available float is between 2% to 15% only. So you can't expect to buy, say, mutual funds to buy 10% of the existing float when you say 27,000 crores and say the float available is not huge. Say the total number between 250 and to 500 is 10 to 15 lakh crores of market cap. The actual float is going to be around, say, 20%, and you are at 3 lakh crores and you expect 25-30,000 crores of buying, implies 10% of all the available shares to be bought. Now that's not going to be practically possible. But the fact is, now what happens is when this rule comes in, this implies it's a big problem for the fund manager. So let me tell you how fund managers have really performed previously. They've performed phenomenally well in terms of alpha in the previous 20 years, even in the, say, in the golden periods of 2003, 2007, there was phenomenal performances by a lot of fund managers, and they are doing their jobs. But the fact is now it is going to be decided by the regulator. The regulator tells there will be 10 schemes. There are barely 5 to 10 say AMCs which have most of the total AUM. Now what happens is when the number of schemes are lower and the number of categories are lower, it implies every scheme will have very large sizes. So that is going to be difficult. And the new rules in terms of say categorization of stocks, allocation to be decided, say like suddenly multi-cap funds you have to buy 25% small caps, and the regulations have constricted the scope of say companies which a fund manager can buy. Now, in my opinion, I've been say a proponent of the categorization of stocks was the first say wrong step by SEBI in terms of for the industry, but I do not understand why did the AMCs not fight tooth and nail in those times. Maybe because they already were very large and say the rule actually helped them get into outperformance because anyways they were holding large cap companies because of their large sizes, and now it is eventually coming to bite them. So ideally, I would have say expected them to fight much more when categorization of stocks happen, because you can't have new categorizations coming every 6 months. So there will be much higher churn for a fund manager if he has to stick very close to the categorization of stocks. And the worst part is the categorization of stocks is on 6 month average full float market cap, whereas the benchmark of a fund manager is all the indices from Nifty 50 to Nifty small cap 100, which are free float based. So there will always be a 10 to 20% mismatch in terms of what is large cap as per AMFI and what is large cap as per the benchmark. Now, so that is the first part. So now the part is how it has become very difficult for a fund manager to outperform. And that is going to be a big game changer going forward. So if you look at it, first, there is no flexibility because of the regulation. The second part is you are in a low depth and a very high concentrated market. So that makes you very inflexible in terms of getting in and out of stocks. You cannot take bets where you can get in and out of companies where you see. And that is one of the reasons we are seeing this large cap polarization, wherein whichever companies have really strong balance sheets are seeing valuations go through the roof. And the third part is your benchmark has become concentrated over the years. So the first, you cannot outperform, as in you cannot do much because of the regulatory hurdle. Second is because of the structure of the Indian markets. And third is your benchmark, which is what you have to outperform. And now this benchmark has gone very, very concentrated. So a few months back, we had 40% allocation in the Nifty to banks, banking and financials, which has come down, but it was that high. Now today we have almost 13 to 14% of the Nifty is represented by Reliance Industries. Another 17% of it is represented by the HDFC Group. So that implies the structure of the portfolio has to be very, very close to these names. But the problem is, we also had HDFC Bank at 12% of the Nifty. The problem is, most of the funds have a mandate, most of the schemes have a mandate to not invest more than 10% into a single stock. So essentially, it implies if any one, two large weights of the Nifty outperform really well for the next, say, 1, 2, 3 years, it's going to be extremely difficult for a fund manager to outperform. In the same way, it was extremely difficult for the insurance fund managers to outperform when they had a sectoral limited 25% on a single sector. Then finally, they used ETFs to actually bolster their holdings in banks and financials by increasing the ETF rate from 5 to 15%. So that is the problem. So now, if this was not enough, performing is going to be tough, but the charges are still high for AMCs. So most of them charge between 0.5% to 2.25, 2.5%. Now, if your alpha is not going to be more than this, how do you justify charging this number? So, and over the years, we've seen all the fund managers have done really well by hitting big sixes out of the park in terms of taking bets which were way out of the benchmark and which did really, really well. Now, with the new regulations, it will be extremely tough for a fund manager to take those bets, because in a 50,000 crore fund, even if you buy a 500 crore market cap, see, even if you take a 200 crore allocation, it goes up 10 times. it's not going to add a lot of alpha, right? So that is going to be a big difference. And with the number of AMCs being very, very small, the number of schemes being very small, every scheme will be very large sized. So for example, a multi-cap fund in Kotak is 30,000 crores. So that is where the problem is going to grow over the next few years. So what I see is there is possibly going to be a big shift in terms of, say, allocations from investors. For example, SIP as a product was not viable 15 years back. When I say it was not viable, I remember the process was to send 6 checks to your distributor, and he would say submit it with his normal daily, say monthly clearing system where he would send it across. This changed when electronic clearing system came in, when we could do SIPs via the internet, and you could do it perpetually or for 36 months and much longer tenures, and you did not have to do anything once that decision has been made. Earlier, the physical, say, creation of a SIP, sending someone across to get checks just did not make it viable. And what do you see when this started changing? The book, which used to be 900 to 2000 crores in 2011 to 13, has gone to 8,000 crores plus. And that's a very huge sum. When I say it's a very huge sum, you are looking at almost 90,000 to 1 lakh crores of inflow from SIP. And this was equal to the number of, say, the exit value of FIIs in 2008. So the net selling of FIIs in 2008 was 1 lakh crores. So today that number is almost being given by SIP. And say if I take a rough estimate, I've not seen the data again, 1/3 of the current equity AUM is almost the SIP contribution. So what it tells you is that is how a product goes from being nowhere in the, say, scheme of selling stuff to becoming 1/3 of the actual AUM. In the same way, what we are seeing is a shift is if it becomes tougher for mutual funds to perform, there is going to be a big shift towards either the ETFs or direct equity investing. Now, the big changes in terms of direct equity investing is the fact that here also technology is an enabler. So, I've always believed in terms of financial products, one is selling and one is technology, which enables the product to go at greater lengths. And that has been the change. So, for example, discount broking came into picture in a big way in two times. One was, say, NSE now, second was when it became easier to onboard clients, which happened in 2016, Aadhaar based KYC. And today, you can open an account with within hours where you can actually say by next day you could actually be buying and selling stocks. I remember we had to actually, if I have to open an account with some, say, broker outside of your city, you have to actually send a courier across. And for example, the way for a broker to grow was having more touch points, which is no more needed. And in the same way, if I have to trade, I had to have some connection. I have to call up the broker, and that has all changed. And the big shift is when you look at the NSE mode of trading, today almost 20 to 25% of the trades are happening through the mobile phone. Now that's a huge change in the cash segment. So what we believe going forward, the big change is going to be towards direct equities and ETFs, and it will be a tough time for mutual funds because of the regulations. And hopefully, if they change, great. And also because even today, in terms of the number of people, say unique people investing in mutual funds, has actually crossed unique people investing through direct equities, which is generally not the case all the time. It has changed. Even in terms of, say, the total, say, allocation, say, for example, I read a Motilal Oswal report where it mentioned as to how in the Nifty 50 for the first time in 20, 25 years or maybe 15 years, DIIs own more than the FIIs in the Nifty 50 and the Nifty 500 in dollar terms. So that has been the big shift in terms of the ownership of domestic institutions. So we believe the next, say, the next few years would be direct equity and ETFs, and that is where one has to look towards either providing services for them or buying into companies which are, say, enablers for a direct equity or ETF participation. And we don't have a lot of companies, say, even broking companies, for example, could be very interesting going forward. Because, for example, I was going through a webinar, say, yesterday, wherein all the best brokers are actually fighting in terms of how small the pie is for broking. So it's not more than a 12,000 crore revenue or a 15, 20,000 crore revenue, say, business. So that is how, say, even the best in the business are fighting out as to how small the pie is. So certain things today point towards eventually over the next few years, this pie of broking, this pie of direct equity investing could be taking a big leap. So that is the big implication. As of now, I'm thinking about how to participate in this. So would love comments on the fact that how to participate in this part. One part is we do run advisory and training services, so that is my contribution. But how to participate in terms of investment idea would be a great discussion. So that is where I end my session. It's just been an impromptu session. I've just made some notes and spoken about it. And say this particular exercise of the video is not going to be actionable, so I've not written a long form post and trying to create more videos. So would love your feedback and comments. Thanks a lot, everyone.